Let's begin by talking about the markets here in India. We've seen the markets end the week in tandem with that bull run that we've seen at the start of the week. So the Nifty has managed to end in the green, and today it's been led by the likes of Bajaj Auto and Grasim. The Sensex as well, ending up close to 900 points up by the end of the week after hitting a record high in the week gone by. And sectorally, we've seen the PSU banking pack ending up as the top gainer, followed by IT stocks, banking stocks and pharma stocks as well. Who did we have on the losing side? We had some of the energy counters and the real estate names as well. But clearly, as for the report that has come out from Jeffries, there is room for correction in the mid-caps. This is what we got from Chris Wood in that latest greed and fear note. He also says that India is the long-term structural growth story. In Asia, it's not China, he says. Let's find out the key takeaways from that note put out by Chris Wood of Jeffries. And for that, Anisha, my colleague, is joining us. Anisha, if you can walk us through the salient points being made in the greed and fear note this time.
Well, yes, Chris Wood was in India on account of that G20 event as well, and no wonder then that he's quite confident about the momentum he's seeing on the ground. As far as the mid-caps is concerned, yes, he talks about the solid rally that we have seen in the mid-cap index this year and calling for some room for correction as well given the valuations. But he says that valuation in big cap stocks are not as extended because the foreign investors are not as overweight India as one would assume it to be. They talk about the flows and the kind of exposure that a lot of these foreign institutions have to India, and it has still not reached a very high level. So there's that room that there'll be more flows coming into India. And of course, the first port of call is going to be the big cap stocks, and that's why they're talking about that. The consensus across the globe, as per him in his conversations with clients across different regions, seems to be that India is a long-term structural story and it's not China anymore. So the increased interest towards India is something that we are watching out for. Of course, he talks about the real rally that has been there in the mid-cap edition, but the continuing rise in oil price is something that he's flagging off as a risk. So one needs to watch out for that, because if the oil prices continue to rise, we might see a bit of dip because inflationary pressures will start, again pressurizing our markets.
Nonetheless, the vote for India is pretty much strong when it comes to the long run. Let's get further perspective on what is being said over here. Punita Kumar Sinha is joining us, managing partner at Pacific Paradigm Advisors, along with Sudip Bandyopadhyay, the group chairman at Inditrade Capital. Thank you both for making the time. Punita Sinha, coming to you first. Tell us how clear and present you see as a danger of a sharp correction in the mid-caps at this point compared to the large caps. Why are valuations of mid-caps looking as extended as this report is indicating?
Well, first of all, I think India is structurally changing also as an economy. And when the GDP per capita for India is going to go up, and I think it will go up exponentially, at that point of time, we can't just limit ourselves to large cap names, because that's only about 200-300 of them. Of course, some of these mid caps will eventually become large caps, so that universe of large caps has to grow. But until, the full story of India gets reflected in these 300 companies, which is not the case. The mid caps and small caps will always be an attractive place to invest, but they have their own challenges of liquidity. But they are almost like a venture fund investing. Some of these small caps, they're listed, but the growth story is that, of like a VC-backed company, very strong growth. And so I think investors do find these opportunities very attractive. Because these companies are the ones that are going to grow exponentially.
Which investors are finding them interesting within the mid-cap universe? Sudip Bandyopadhyay, the Jeffries note is talking about how FIIs are not as overweight on India as expected. Why do you think that's the case, considering that most of the current upsurge is driven by domestic investments? And if mid-caps are looking as promising, is that the area where they would be most interested in, the mid-caps?
Well, I think there are two things we need to understand. One is the correction in mid-cap, which we saw. It looks overextended or overdone, predominantly because of the fact, if you look at the index, 75% of the index weight is for the large caps, and about 25% is a whole lot of mid caps. Now, when there is a shift to large cap, even if there is a small shift to large cap, it has a huge impact on the mid caps because of this sheer weight structure. If there is a 1% move to the large cap, that creates a huge downside when there is a money is moving out of mid and small cap to large cap. Now that one needs to understand to realize the magnitude of what is happening. That's the first point. The second point is, yes, some of the mid cap stocks were looking richly valued, and some amount of correction probably was warranted. Now, having said that, I must very clearly mention here that it's not that all mid caps were overvalued or all mid caps need to get corrected. There were some mid cap and small cap stocks which definitely were looking richly valued, and some amount of profit booking or correction was warranted. Similarly, a whole lot of large cap stocks, when you compare them with the valuations of mid and small cap, were looking attractive at a couple of weeks back before all this started happening. So obviously, little bit of change, little bit of movement was warranted. The second thing which is important and one must understand is that there is a little bit of change in US market conditions. One, I think the oil prices going up and the possibility of US Fed hiking one more.
We seem to have a bit of a connection issue with Mr. Bandyopadhyay, but taking off from that point, Punita Sinha, looking at the macro data that's emerging from the US, their inflation picture, expectations of the Fed a little later this month, and the way the dollar has moved, oil prices too, and of course the kind of spike we've seen in US bond yields that have now at least moderated a bit. How do you expect foreign fund flows to move now?
See, the foreign fund flows have been moving to India mainly from a lot of the emerging market funds where China has become like almost a very low weightage. So I was speaking to one sell-side strategist recently this week in the US, and they were saying that a lot of hedge funds in particular have gone to almost zero weight in Hong Kong, China. And a lot of that money has come to India. So that is what is driving up the Indian market. And on your question in terms of the mid and small caps, yes, I mean, if you look at the technicals, they've been overbought. But if you look at the long-term story, obviously any correction would mean that if you're a patient investor, you'd find a lot of growth opportunity there. So you have to balance the short term with the long term. Now, in terms of US macro, yes, oil prices have been going up. In fact, in July, our models were showing risk rising because of these macro factors, which is oil prices, bond yields were spiking up a little bit. And we're also heading into elections in many, many countries. So all of those pointed to some risk levels rising, but the markets have been ignoring those risks for the last 2-3 months. So I think China's also cut rates. So we may see some money flow back into China if they give enough stimulus. And I think it's going to be a mixed sort of story. I don't see US yields going up immediately. And the Fed watch numbers are not indicating a high probability of that happening. But I think given where valuations are, given the technicals, a correction, if it comes, would be healthy.
The global cues are not the most positive right now, Mr. Bandyopadhyay. Everything that Punita Kumar Sinha is pointing out as well. But despite what we're hearing about Europe, and yesterday we've seen ECB hike those rates to the highest level that they possibly have, of course indicating the end of the rate hike cycle. But yet, this entire bullishness on India, how strong do you think are the fundamentals right now? This correlation that we see between capex cycles, corporate growth as indicated in the kind of reports, the earnings reports that we get, the credit growth among our financial sector, and the way the markets are now moving up after that consolidation we saw in August. How much of a correlation do you see, and this robustness, this entire positive feeling about India that's coming through despite not so positive global cues? How do we peg this?
Well, I think two things are extremely important. One is I think oil prices globally has moved up, and that is definitely a negative for India. But on the other hand, the counterbalancing factor is that most of the global investors are extremely cautious about China. As we are aware, a lot of them have moved money out of China and into India, and many of them would like to do that, do the same in the near future. China is trying hard. The Chinese government is trying hard to do something to revive the economy, but I think it's a huge challenge they're facing. Now, under the circumstances, with the kind of GDP growth, economic growth India is demonstrating, will definitely attract foreign investors. Give or take this month, that month, US, Fed increase in interest rates, little bit of risk aversion here, positive mindset there. But if you look at a 6 month, 1 year, and 5 year time horizon, it is very clear that money will move into India and Indian equities from international investors. Now, if that is the case, I think Indian investors are not going to sit idle. They also have been putting money in Indian capital market. The other important thing which is happening is financialization of savings. A huge part of Indian savings used to be in unproductive assets like gold and other form of cash holding and things like that. Now, a lot of money is coming into the market either directly or indirectly through the mutual fund and insurance route. Now, this financialization of savings, I think it's just the beginning. Quite a lot of path is yet to be traversed, and as and when this happens, and as we go along, more and more Indian money will be in Indian capital market, and that is extremely important for us to understand and the health of the Indian capital market and the economy. While this is happening, we will continue to see that in spite of FII selling, domestic institutions, domestic investors are not only absorbing the sale volume, but also pushing the market up, as was happening in the last week. So overall, I think we are in a positive, we have a very clear positive bias as far as the markets are concerned. Short-term volatility, short-term correction, profit booking can happen. But if you look at medium to long term, I think it's absolutely clear that Indian markets will continue to move up.
About foreign investments into Indian markets, Punita Sinha, how these large foreign institutions are now looking at asset allocation. That's an important piece to consider as well, because now China is a big part of the emerging market index, and a lot of money is actually flowing away from the passively managed funds just to avoid China. Tell us exactly how it's going to work sectorally speaking as well when it comes to the asset allocation done by some of these foreign institutions.
So first of all, I think I wanted to just add to what Sudip said.
Sure.
So in the 90s, foreign investors were driving the Indian market because there was not enough domestic capital. And anytime we sold, the market corrected. Now there's so much more depth to the Indian market because the Indian market is not that dependent on foreign capital. It's much more dependent on Indian capital. And with the capital controls that we have in India, where Indian mutual funds and Indian investors cannot invest overseas, that means all the money is locked up in India. And so there is no choice from their asset allocation perspective but to invest in India. So that actually provides a very good floor to Indian equities, and perhaps one of the reasons why Indian equities trade at a premium valuation to its own, to other countries is because you have this pool of capital that doesn't have much other opportunities. Now, US investors obviously can allocate to any country, any asset class, and a lot of money has also gone into money market funds where you're getting 4.5%, 5%, which is pretty good and higher than what we've seen in the last several years. So I suspect that as the risks rise, which you've talked about, and we head into elections, then there is going to be perhaps some money that will flow out of risky assets and go into a bit more risk aversion. And that might also impact flows into emerging markets. But still looking better value than the US.
No taking away from that, and that's what the note is indicating about how strong the Indian growth story seems at this point in time in the long run. That's where we're leaving it. Sudip Bandyopadhyay and Punita Kumar Sinha, always a pleasure getting in your perspectives. Thanks very much for joining us on India Tonight.